Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Post Holdings Inc. quarterly report. Post Holdings Inc. offers a diverse range of consumer packaged goods through its four segments: Post Consumer Brands, Weetabix, Foodservice, and Refrigerated Retail. The Post Consumer Brands segment provides ready-to-eat cereals under well-known brands such as Honey Bunches of Oats, Pebbles, and Malt-O-Meal. It also offers peanut butter under the Peter Pan brand and pet food under various labels, including Rachel Ray Nutrish and Nature's Recipe. The Weetabix segment manufactures RTE cereal, hot cereals, and other cereal-based products under its own brands, as well as private labels. The Foodservice segment produces egg products primarily under Papettes and Abbotsford Farms brands, along with potato products for the foodservice and ingredient channels. It also manufactures certain meat products. The Refrigerated Retail segment offers a variety of products including side dishes, potatoes, sausage, eggs, cheese, and dairy products under various labels such as Bob Evans, Crystal Farms, and Simply Potatoes. In total, Post Holdings provides its products to a wide range of customers including grocery stores, mass merchandise retailers, supercenters, club stores, natural/specialty stores, dollar stores, discounters, wholesalers, convenience stores, pet supply retailers, drugstore customers, food service distributors, national restaurant chains, and military channels. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what may cause a stock's price to remain stagnant over a period of time. The stock market is known for its unpredictability, and there are numerous factors that can contribute to a company's stock price remaining unchanged over a year. One possible reason is a lack of significant news or events that would impact the company's performance or industry trends. This could be due to the company's stable financials, consistent revenue growth, or a lack of major competitors entering the market. Another factor could be the overall market conditions. If the broader market is experiencing a downturn or stagnation, it may affect the stock price of individual companies, including Post Holdings, Inc. Additionally, regulatory changes, industry trends, and global events can also impact a company's stock price. Furthermore, internal factors such as management decisions, product launches, or mergers and acquisitions can also influence a company's stock price. If these efforts are not yielding the desired results, it may lead to a stagnant stock price. In conclusion, there could be various reasons why Post Holdings, Inc.'s stock price has remained unchanged over the past year. A combination of internal and external factors, including market conditions, industry trends, and company-specific events, can all contribute to this phenomenon. Post Holdings, Inc. market capitalization of $6 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Post Holdings, Inc. holds a significant advantage in their industry. Post Holdings, Inc. trades at a lower price-to-earnings ratio of 21 times and a higher price-to-book ratio of 1.59 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 72% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the company's financial performance. On the positive side, revenue growth is driven by several key factors. Net sales increased by 10.6% from 2024 to 2025, with significant contributions from Post Consumer Brands, Foodservice, and Weetabix segments. Within these segments, specific products such as nut butters and protein-based shakes have seen substantial growth, with net sales increases of 275% and 9%, respectively. In contrast, revenue decline is attributed to several factors. The sale of 8th Avenue has resulted in a decrease in net sales, while the refrigerated retail segment has experienced a significant decline of $266.6 million. Additionally, pet food and cheese and dairy product revenues have decreased by 11.9% and 3.3%, respectively. These declines are also reflected in the company's cash provided by operating activities, which was impacted by fluctuations in trade payables and inventory purchases. Overall, the drivers of revenue growth or decline can be summarized as follows. Revenue growth is driven by strong performance in key segments such as post-consumer brands and food service, while revenue decline is attributed to the sale of 8th Avenue, declines in refrigerated retail segment, and decreases in pet food and cheese and dairy product revenues. Net income decline and profit margin shift. The company's net income experienced a significant decline from $113.3 million in 2024 to $96.8 million in 2025, representing a decrease of 14.3%. This downturn was not accompanied by any specific reason mentioned in the extracted summaries. However, it is worth noting that an acquisition and restructuring costs led to an increase in net income in previous years. Despite the overall decline in net income, there were some variations in profit margins across different segments. The operating profit margin increased from 10.9% to 11%, indicating a slight improvement. Conversely, the segment profit margin for post-consumer brands decreased from 14% to 12%. These mixed results suggest that while the company's overall profitability may have suffered, certain areas of its business showed resilience and growth. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the provided information, in 2025, the company achieved an operating cash flow of $1,421.8 million, while in 2024, it was $1,434.9 million. Furthermore, on page 32, it is confirmed that the company is indeed generating positive operating cash flow, with specific amounts mentioned for both periods. $235.7 million, 2025, and $310.4 million, 2024. These figures demonstrate a strong financial position, indicating that the company is capable of producing sufficient cash to cover its operational expenses. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, there was no significant change in debt level on pages 4 and 15. However, a decrease of $36.2 million was observed on page 18, indicating a reduction in debt. Conversely, an increase from $7,452.2 million to $7,507.2 million was noted on page 35. Regarding interest expenses, there has been a notable increase. On page 29, it is reported that the net interest expense increased by 23% or $19.3 million in 2025 compared to 2024. Additionally, an increase of $16.6 million in interest payments was observed on page 33. Furthermore, the loss on extinguishment of debt has also seen a significant rise, with a 202% increase from $5.8 million to $17.5 million noted on page 29. The data suggests that while there were some instances where the debt level remained unchanged or decreased slightly, the overall trend indicates an increase in both interest expenses and loss on extinguishment of debt. This could be indicative of a shift in the company's financial strategy or market conditions affecting its operations. Management statements suggest a cautious yet optimistic approach to the company's financial situation. They anticipate continued positive cash flows from operations, which indicates a stable financial foundation. However, they also prioritize working capital requirements and interest payments on long-term debt in the short term, highlighting their focus on maintaining liquidity. In terms of long-term strategy, management is open to exploring growth opportunities through acquisitions and other strategic transactions. This implies that the company is looking to expand its operations and increase revenue streams. Additionally, management has not ruled out share repurchases based on market conditions and liquidity requirements, which could be a way to return value to shareholders. Overall, management's comments convey a sense of prudence while also leaving room for growth and expansion. They are aware of the potential risks and uncertainties that may impact future results, but seem confident in their ability to navigate these challenges and achieve their goals. The company has made several strategic moves through acquisitions and divestitures to shape its business portfolio. In terms of acquisitions, the company has expanded its operations by acquiring 3 key entities: 8th Avenue Food and Provisions, Inc., Potato Products of Idaho, LLC, and Pet Food Assets and Operations. These acquisitions are expected to enhance the company's offerings and capabilities in the market. On the other hand, the company has also divested certain business units to focus on its core activities. Specifically, it has sold its pasta business under 8th Avenue and its interest in Bellring Brands, Inc. These divestitures aim to optimize the company's resources and streamline its operations. The company's financial activities have been transparent and strategic. One notable move is its decision to buy back shares, as mentioned on page 32 of the report. This action demonstrates a commitment to shareholder value and a willingness to invest in the company's own equity. By repurchasing shares, the company aims to increase earnings per share and boost investor confidence. Concerns about inventory buildup and supply chain disruption have been raised due to various factors. Inventory levels have increased significantly, with a notable $182.7 million in buildup mentioned on page 9. This trend is consistent across different segments, including raw materials and supplies, $187.20, and finished products, $658.10, as highlighted on page 12. Furthermore, the impact of supply chain disruptions has also been noted. The highly pathogenic avian influenza, HPAI, outbreaks have affected egg supply, leading to inflationary pressures on input costs. Additionally, potential future modifications or incremental tariffs could exacerbate supply chain challenges. Distribution losses and reductions in co-manufactured and private label products are also mentioned as supply chain disruptions. The potential concerns for the company's supply chain are multifaceted. Volatility in the cost or availability of inputs, disruptions or inefficiencies in supply chain, labor shortages, public health crises, weather events, fires, HPAI, and other agricultural diseases and pests all pose significant risks to the company's operations. These factors highlight the need for careful management and mitigation strategies to address these concerns and ensure a stable supply chain. That concludes the financial summary for Post Holdings, Inc. Feel free to comment below, and I will be happy to answer them when possible.